Silver breached $80, then something unprecedented happened. For the first time in modern market history, the spot price began trading higher than futures contracts. Backwardation, a signal that hasn't appeared since the structural collapse patterns of previous decades. But this time, the physical metal is vanishing. 800 million ounces. Gone from global supply over 4 consecutive years. China announced export restrictions in October. The United States declared silver a critical mineral. And now, constitutional challenges threaten to unravel $250 billion in collected tariffs. Craig Hemke, a 15-year market analyst, has issued his most aggressive forecast ever, not because of speculation, but because the fractional reserve pricing system is showing stress fractures. What happens when the leverage breaks? Welcome to Currency Archive. If you've built a career understanding how markets truly function, you're in the right place. We don't chase headlines here. We analyze the structural shifts that reshape economies before they become obvious to everyone else. Now, if you value this kind of strategic economic analysis, the kind your financial advisor won't discuss and mainstream media won't touch, I'd appreciate if you'd subscribe to this channel. Just click that button below. It takes 2 seconds, but it tells us you're serious about understanding what's actually happening in global markets. And before we continue, tell us in the comments. Where are you watching this from today? Are you in North America, Europe, Asia, or somewhere else entirely? We're building a community of serious thinkers here, and I'm curious to know where our audience is positioned as these market shifts unfold. Now, let's examine exactly why Craig Hemke believes we're entering the most significant precious metals cycle in modern history. On January 8th, 2026, Craig Hemke sat down for an interview that would challenge everything traditional investors believed about precious metals. Hemke, a market analyst with 15 years of experience tracking gold and silver, made a statement that seemed almost reckless. He was more bullish than he had ever been in his entire career, not because of hype, not because of speculation, but because the physical market was showing signs of structural breakdown. Silver had just crossed $80 per ounce. Gold was trading near historic highs. And for the first time, Hemke believed this rally was fundamentally different from every previous spike in precious metals history. To understand why, one must look back at what happened in 1980 and 2011. In 1980, silver rocketed to $50 in just 4 months, then collapsed back to $10 in 2 months. It was a speculative bubble, pure and simple. In 2011, silver reached $48 on October 2nd, then spent the next 13 years falling and consolidating. Another spike, another collapse. But October 2nd, 2024 marked something different. That was the day silver entered backwardation. Backwardation is a technical term, but its meaning is simple and alarming. It means the spot price, the price for immediate physical delivery, began trading higher than the futures price. In normal markets, futures trade at a premium because of storage costs and time value. When that relationship flips, it signals one thing: physical shortage. The market is screaming for metal right now, not promises of metal in 3 months. And this backwardation didn't just appear for a day or two. It persisted through October, eased slightly, then returned with force. On the morning of January 8th, during heavy overnight selling, backwardation reached 30 to 40 cents. The spot price was trading 30 to 40 cents higher than the March futures contract. This was not normal market behavior. This was stress. But backwardation was only one signal among many. Lease rates in London, the rates at which bullion banks lend physical metal, were rising. Vault stocks, the actual physical inventory held in exchange warehouses, were declining. And the numbers behind these signals were staggering. For 4 consecutive years, the silver market had run supply deficits. Not small deficits, but structural shortfalls totaling 800 million ounces. 800 million ounces of silver, consumed and not replaced. That represents years of mining production simply gone. Industrial demand had absorbed it, investment demand had absorbed it, and the supplies were not being replenished. Then governments began to act. In October 2024, China announced it would begin controlling silver exports. The Chinese government, recognizing silver's critical role in technology and manufacturing, decided it would no longer allow unrestricted flow of the metal out of the country. Shortly after, the United States declared silver a critical mineral. This was not symbolic. This was strategic resource designation, the kind typically reserved for materials essential to national security and economic stability. Suddenly, silver was not just a precious metal. It was a strategic asset. And strategic assets, as history shows, do not trade based on technical chart patterns or speculative momentum. They trade based on physical availability and geopolitical necessity. Hemke understood this distinction clearly. He noted that many analysts were calling silver overbought. The technical indicators, the relative strength index, the moving averages, All suggested the metal had risen too far too fast. But Hemke rejected this analysis entirely. He argued that technical indicators only matter when markets are driven by speculation and derivatives trading. When physical scarcity enters the equation, when governments start hoarding, when supply deficits persist year after year, technical analysis becomes almost irrelevant. The morning of January 8th proved his point perfectly. Silver opened down 5% in U.S. trading. Why? Because overnight in Shanghai, the price had fallen 6%. And why had Shanghai fallen? Because the Shanghai exchange had raised margin requirements. Higher margins forced traders to either deposit more cash or liquidate positions. They liquidated. Shanghai weakened, which allowed additional selling pressure in London, which then cascaded into New York, 5% down in a matter of hours. But none of this had anything to do with fundamental supply and demand. It was purely a function of exchange mechanics and margin calls. And here was the critical insight Hemke offered. These were physical markets driving price action, not paper speculation, not algorithmic trading, not derivative positioning. Physical markets in Shanghai, physical markets in London, physical markets creating real price discovery. If someone tried to drive the paper futures price down to $60, but physical metal continued trading at $70 in spot markets, that paper price would not hold. Arbitrage would destroy it immediately. Traders would buy the cheap futures, demand physical delivery, and sell at the higher spot price. The fractional reserve system that had governed precious metals pricing since 1975 was beginning to show cracks. And once those cracks widened, no amount of technical analysis or derivatives trading could hold back the physical reality. The metal was disappearing, and the world was starting to notice. In the first week of January 2026, a narrative began spreading through financial markets like wildfire. Commodity index rebalancing, the term sounded technical, complex, and for most investors, deeply concerning. Major financial institutions started warning their clients. Bloomberg terminals lit up with alerts. Zero Hedge published articles with alarming headlines. The message was clear. Gold and silver were about to face massive selling pressure. $4 billion worth of gold futures would be liquidated. Billions more in silver contracts would flood the market. The rebalancing was coming, and prices would collapse. Except, none of this made any sense. Craig Hemke saw through the narrative immediately. He had first learned about the commodity index rebalancing on the first trading day of the year, January 3rd. Ole Hansen, a commodity analyst at Saxo Bank, had posted the details on social media. The Bloomberg Commodity Index and similar indices had performed annual rebalancing. Because gold and silver had performed so well in 2025, their weightings in these indices had grown too large. The indices needed to sell some precious metals positions to bring the allocations back to target levels. This was standard procedure, happened every year, and was entirely predictable. But suddenly, it was being presented as a catastrophic event. Hemke broke down the actual numbers. $4 billion in gold futures sounded massive. But what did that actually represent in the COMEX gold market? Approximately 10,000 contracts. 10,000 contracts spread over 5 trading days. That meant 2,000 contracts per day would be sold. Now, what was the average daily trading volume in COMEX gold? Between 150,000 and 200,000 contracts. 2,000 contracts represented roughly 1 to 2% of normal daily volume. This was not a tsunami. This was barely a ripple. The silver situation was identical. 10,000 silver contracts would be liquidated over 5 days. Silver's daily volume was lower than gold, perhaps 100 to 150,000 contracts on a typical day. So yes, the impact would be slightly more noticeable in silver, but still, it was hardly the market-moving event being portrayed in financial media. Hemke watched with mild amusement as gold prices dipped on Wednesday, then recovered on Thursday. By the time he gave his interview on January 8th, gold had already bounced back into positive territory. The rebalancing narrative had been exposed as exactly what it was: market noise, amplified by institutions trying to shake out weak hands before the real moves began. But while everyone obsessed over irrelevant rebalancing, they were completely missing what was actually about to hit the market. Friday, January 9th. That was the day that mattered. 2 events were scheduled that would genuinely impact precious metals prices, and almost nobody was talking about them. First, the December employment report would be released. This was the first legitimate jobs report since early September, nearly 4 months prior. The Federal Reserve had not cut interest rates in January. That much was certain. But there was approximately a 50-50 probability of a rate cut in March. The December jobs report would directly influence that probability. If employment came in weak, rate cut odds would rise, the dollar would weaken, and gold and silver would strengthen. If employment surprised to the upside, rate cut expectations would diminish. The dollar would rally, and metals would face pressure. This was straightforward market mechanics. But the second event scheduled for Friday was far more significant: the Supreme Court ruling on tariff constitutionality. Most people had forgotten about this entirely. Back in April 2025, President Trump had announced comprehensive tariffs. The markets had reacted violently. Silver, which had been trading at $36, collapsed to $28 in just 3 days, an $8 drop, roughly 22%, in 72 hours. The tariffs were challenged in court on constitutional grounds. The case was argued before the Supreme Court in November 2025, just before the holiday break. Now, in early January, the court was back in session. Multiple rulings were expected on Friday morning, and the tariff case was among them. The implications were staggering. If the tariffs were ruled unconstitutional, the government would potentially have to refund $250 billion already collected, perhaps even $300 billion depending on timing and scope. Where would that money come from? The deficit would explode overnight. The Treasury would need to issue massive amounts of new debt. The Federal Reserve would face enormous pressure to provide liquidity, and precious metals, which thrive in environments of fiscal chaos and currency debasement, would likely surge. Hemke noted the irony with a slight smile during his interview. When tariffs were announced, silver fell 22%. Logic would suggest that if tariffs were struck down, silver should rise 22%, but markets never work with such clean symmetry. The initial tariff announcement had caused panic selling, a knee-jerk reaction to perceived economic damage. A ruling striking down the tariffs would unfold more slowly. First would come legal analysis, then fiscal impact assessments, then gradual market repricing. But make no mistake, if the tariffs fell, the long-term impact on precious metals would be extraordinarily bullish. It would represent yet another confirmation that the U.S. government had no credible path to fiscal restraint, no way to close the deficit, no mechanism to avoid currency debasement. And in that environment, gold and silver would continue their structural advance. While financial media obsessed over 1 to 2% of daily volume from index rebalancing, the real market drivers were being completely ignored. Employment data that would reshape Federal Reserve policy expectations. Constitutional challenges that could blow a $300 billion hole in federal revenues. These were the events that mattered. And Friday, January 9th, was going to be volatile. Something unusual was happening beneath the surface of global markets. Governments were moving, not with press releases, not with diplomatic statements, but with concrete actions that signaled a fundamental shift in how nations viewed strategic resources. Craig Hemke observed this pattern with growing conviction. The United States and China, the world's two largest economies, were no longer operating as integrated trading partners. They were positioning themselves as potential adversaries. And when nations prepare for conflict, even cold economic conflict, they secure resources first. The signs were everywhere for those paying attention. On a Saturday morning in early January 2026, U.S. Special Forces entered Venezuela. They extracted President Maduro from power and removed him from the country entirely. The operation was swift, decisive, and shocking in its boldness. Hemke had been waiting all morning for that moment. Rubio's words were precise and deliberate. Trump is not a game player. When he tells you he's going to do something, when he tells you he's going to address a problem, he means it, he actions it. This is a president of action. If he says he's serious about something, he means it. For decades, American politicians had spoken in carefully hedged language. They threatened, they condemned, they imposed sanctions. They wrote strongly worded letters. But direct military action to remove a foreign leader, that belonged to a different era, or so everyone thought. Hemke recognized immediately what this signaled. The administration was not bluffing about anything. Not about Greenland, not about critical minerals, not about resource security. When Trump discussed acquiring Greenland, most analysts dismissed it as rhetorical posturing. But what if it wasn't? What if the administration was genuinely exploring mechanisms to secure strategic territory rich in rare earth minerals? The mathematics were fascinating. 50,000 people lived in Greenland. What if the United States offered each resident $1 million in exchange for a vote on becoming a U.S. territory? That would cost $50 billion. Still too expensive? Offer $10 million per person. That's $500 billion. Absurd amounts of money. Except the resources beneath Greenland's surface were worth multiples of that figure. Rare earth elements, uranium, potentially massive silver and copper deposits. These were the materials that powered modern military technology, renewable energy systems, advanced electronics. Whoever controlled these resources controlled future industrial capacity. And this was where precious metals entered the equation. China had already made its move in October 2024. Export restrictions on silver, export restrictions on rare earth elements, tightening control over antimony, gallium, germanium. The message was unmistakable. China would no longer supply the West with materials that could be used against Chinese interests. If Western nations wanted these critical minerals, they would need to secure their own sources. The United States responded predictably. Silver was declared a critical mineral. Drill, baby, drill became official policy. Even though the U.S. was already the world's largest crude oil producer, the administration wasn't trying to increase production for profit. They were ring-fencing resources, ensuring domestic supply could not be disrupted by foreign actors. Hemke drew a direct line from these geopolitical moves to precious metals pricing. The Western pricing system for gold and silver had functioned the same way since January 1975. It was built on derivatives, not on leverage, on fractional reserve banking principles. The actual physical metal served as a base, but that base was leveraged dozens of times over through futures contracts, options, and other paper instruments. This system worked perfectly well, as long as physical metal remained abundant and freely traded across borders. But what happens when the physical base starts shrinking? What happens when governments begin hoarding instead of trading? The leverage ratios stretch. Imagine a bank that operates on fractional reserves. It holds $100 million in actual deposits, but it has lent out $1 billion. That's 10-to-1 leverage. As long as only a small percentage of depositors want their money back at any given time, the system functions. But if suddenly depositors start demanding physical cash, if they lose faith in the paper claims, the bank collapses. This was the dynamic now playing out in silver and gold markets. 4 straight years of supply deficits had removed 800 million ounces of silver from available inventory. Central banks had purchased thousands of tons of gold, removing it from tradable markets and locking it in vaults. China was restricting exports. The United States was restricting exports. The physical base was shrinking. But the paper claims, the futures contracts, the derivative positions, those continued to multiply. The leverage was stretching to dangerous levels, and when leverage stretches too far, it snaps. Copper provided a parallel example. Copper had just hit all-time highs, $13,000 per ton in London. Why? Because copper was essential for electrical systems, for renewable energy infrastructure, for military applications, and governments were securing copper supplies just as aggressively as they were securing silver. Hemke emphasized this point repeatedly during his interview. This was not about temporary market momentum. This was not about speculative enthusiasm that would fade when sentiment shifted. This was about structural changes in how nations approached resource security. And structural changes, by definition, do not reverse quickly. Nobody was expecting what Hemke called peace-loving Bobby Sherman to emerge in 2026. Nobody expected nations to suddenly hold hands and return to unrestricted global trade in critical minerals. The geopolitical trajectory was set. The resource competition was intensifying. And precious metals, sitting at the intersection of monetary value and industrial necessity, were caught in the middle. Hemke noted one more critical element. Treasury Secretary Scott Bessent had been signaling for over a year that the administration would run it hot. Balanced budgets, abandoned. Doge spending cuts, forgotten. The only path forward, the only way to forestall economic collapse, was aggressive fiscal expansion combined with monetary accommodation. Cut short-term interest rates as much as possible. If long-term rates rise due to bond market selling, implement yield curve control. Keep borrowing, keep spending, keep the system liquid at all costs. This was not conspiracy theory. This was stated policy. Repeated in multiple interviews and official statements, and stated policy from an administration that had just demonstrated it meant what it said. By sending Delta Force into a sovereign nation to extract its president, when people tell you who they are, believe them. When governments tell you their strategy, believe them. The resource war was no longer theoretical. It was happening in real time. And precious metals were about to reflect that reality in their pricing. At the beginning of 2025, Craig Hemke made a forecast that seemed unreasonable to most market observers. Gold would reach $3,100 by year end. Silver would climb into the high 30s. The reactions ranged from skeptical to openly hostile. Critics pointed to the strengthening dollar, to expectations of massive government spending cuts under Doge, to the narrative that gold was already in a bubble at $2,600. Gold had already risen 27% in 2024. Predicting another 10% gain seemed greedy. Predicting 30% more upside in silver seemed delusional. The term permabull was thrown around frequently. Hemke was dismissed as someone who always predicted higher prices, regardless of actual market conditions. Then, something unexpected happened. Gold and silver didn't just meet those targets, they obliterated them. By December, gold had surged past $4,200. Silver had crossed $80. And suddenly, Hemke received a different kind of criticism. He got an email calling him an idiot for being too conservative. How could he have only predicted 10 and 30% when the actual gains were so much larger? This was the no-win situation of making public forecasts. Too bullish, and you're a reckless hype artist. Too conservative, You're incompetent for missing the obvious trend. But Hemke understood something most forecasters did not. Markets don't move in straight lines. They move in patterns, in rhythms, in waves of expansion and consolidation. And if you can identify the pattern, you can project forward with reasonable accuracy. Since March 2024, when gold broke out to new all-time highs, it had followed a consistent structure. 20% rallies, followed by 2 to 4 month consolidations, followed by another 20% rally. The pattern repeated with remarkable consistency. In summer 2025, gold was trading around $3,500. Hemke noted the pattern and made a simple calculation. 20% higher would take gold to $4,200 or $4,300. That's exactly where it topped in the fourth quarter. Gold then entered consolidation in October and had been consolidating since. The pattern suggested another breakout was coming. 20% above the current $4,300 level would reach approximately $5,200. Assume that breakout happened in spring, followed by another consolidation through summer, then one more 20% rally before year end. That would bring gold to roughly $6,000 by December 2026. This was not wild speculation. This was pattern recognition applied to a trending market. Silver was following a similar structure, but on a compressed timeline. Gold had taken 21 months to double from its March 2024 breakout. It doubled from roughly $2,600 to over $5,200 at the peak. Silver broke out to new all-time highs in October 2024. If silver followed the same doubling pattern as gold, but in half the time, it would reach $100 by summer 2026. Michael Oliver, a technical analyst Hemke respected, was even more aggressive. Oliver predicted silver would hit $100 by the end of the first quarter. Whether that timeline was accurate or not, the direction was clear. Silver had momentum. It had physical support from supply deficits. It had government hoarding creating artificial scarcity. A move to $120 by year end was not only possible, it was probable, given the structural factors in play. Hemke acknowledged his methodology was not particularly scientific. He wasn't running complex algorithms or building elaborate econometric models. He was simply observing what the market had been doing and assuming it would continue until something fundamental changed. And nothing fundamental had changed. The supply deficits continued. Government resource hoarding continued. Central bank gold purchases continued. Federal deficit spending continued. Why would the price patterns suddenly reverse? Critics would point to technical indicators showing extreme overbought conditions. The monthly relative strength index for silver was at levels never seen before. Surely that meant a massive correction was inevitable. But Hemke rejected this logic entirely. Technical indicators only matter when markets are driven by speculation and paper trading. When physical scarcity dominates, when governments are competing for limited supplies. Technical indicators become background noise. If silver's paper price fell to $60, but physical metal continued trading at $70 in spot markets, arbitrage would immediately correct the discrepancy. The paper price would be forced back up. The fractional reserve system could not sustain a large disconnect between paper and physical pricing. One of the biggest challenges facing precious metals investors was information quality. The internet had become flooded with false narratives about silver. AI-generated videos repeated claims that the COMEX exchange nearly failed on Thanksgiving. Conspiracy theories circulated that JP Morgan held 700 million ounces and was 100% long. These stories were easily disprovable, but they spread rapidly because they sounded dramatic and people wanted to believe them. Hemke's 15 years of market analysis gave him the perspective to separate signal from noise. When ridiculous bearish narratives emerged, like the commodity index rebalancing crisis, he could debunk them with actual numbers. When ridiculous bullish narratives emerged, like exchange failure theories, he could debunk those as well. This grounded perspective had value. It kept investors focused on what actually mattered: physical supply and demand, government policy, central bank behavior, deficit spending trajectories. These were the real drivers. Everything else was distraction. As Hemke looked toward 2026, he saw no reason for the fundamental trends to reverse. The US and China were not suddenly going to cooperate on resource sharing. The Federal Reserve was not going to implement austerity and raise rates aggressively. The physical supply deficits in silver were not going to resolve overnight. Therefore, higher prices were almost inevitable. $6,000 gold, $120 silver. These were not fantasies. These were logical extensions of observable patterns and structural market conditions. Hemke's final message was simple. The trends that began in 2024 and accelerated through 2025 were almost certain to continue through 2026, not because of hype, not because of speculation, but because the physical reality of scarce resources, combined with unlimited government currency creation, could only resolve one way: higher prices. The only question was how much higher. and how quickly the fractional reserve pricing system would crack under the pressure of vanishing physical supply. For serious investors, for business leaders, for anyone managing significant capital. The message was clear. Precious metals were not a trade. They were a structural position in a world where governments had chosen resource competition over cooperation and currency debasement over fiscal discipline. The forecast was set, the patterns were clear, and 2026 would reveal whether Craig Hemke's most bullish call ever was bold enough